I'm seeing a lot of people be pretty optimistic for 2023, at least in terms of the stock market and their investments. But I just want to urge you guys to be careful because the Fed is saying the exact opposite. And so that's what I'm going to cover in this video. So guys, as you smash that like button, let me run the intro. What's up guys, and welcome back to the channel. And some of you guys just may have been on holidays and you might have missed this announcement, but let's go right into the article. So you can see that in their last meeting, this was actually published just a couple of days ago on January 4th. So some of you guys might actually have seen it, but Fed officials see higher rates for some time ahead. And so, a lot of people are thinking that because the yield curve is inverted, that, we enter into a recession in 2023 and then they reduce interest rates, and hopefully that's like pops some of our securities, but that might not necessarily be the case. And this is what the article went on to say. So the Fed remains committed to fighting inflation, and they expect higher interest rates to remain in place until more progress is made. So they're telling you what they're doing. And sorry, these minutes were released on Wednesday. So, a lot of you guys would have been back from the holidays when this came out, but it's the first week back and a lot of us were busy. So you might have missed this like I did. And so effectively, most participants observed that the restrictive policy will need to remain in place until the incoming data provided confidence that inflation was on a sustained downward path to 2%. Which is likely to take some time. And, what they're really worried about is that they're worried about prematurely loosening monetary policy. And of course, the reason why they're worried about that is because they just don't want inflation to come back and surge if they just sort of started reducing interest rates too soon. But, I don't feel like this job is very enviable for the Fed because you're kind of in between a rock and a hard place right now. Because if you do reduce interest rates too soon, you could surge inflation, which would hurt the people lowest on the economic spectrum. However, if you keep interest rates high for too long, you also hurt the people lowest on the economic spectrum because they obviously are the first ones let go. So they're either hurt by inflation or they're either hurt by unemployment. And so, it's a really tough situation that we're in. Now, Goldman Sachs believes that there will be a soft landing, and the Fed is trying to sort of navigate themselves into getting to that soft landing, but we'll see how this plays out. History begs to differ. Now, recall, guys, the Federal Reserve did raise the federal funds rate in their last monetary policy meeting of 2022. They raised it by 50 basis points, but just recall the absolute surge in the rate in the last, I would say, 12 months. And so this is the fastest trajectory of federal funds rate increases in history, or at least in recent history. But here's what I found interesting. In the article, they suggest that current pricing indicates that there's a possibility of small reduction in rates by the end of the year, with the federal funds landing around the range of 4.5 to 4.75. I absolutely don't believe that, but it's interesting how the current pricing sort of indicates that. I guess what they're saying is that some investors are sort of betting on that. I'm not really so sure about that, and the Fed officials have expressed doubt repeatedly about any loosening of policy in 2023, and so the market may be a bit too optimistic here. And here's where I say they are warning you guys. They are warning you that it's going to be a tougher economic environment for longer. So why would you fight the Fed? Why would you bet against them? It doesn't make sense to me. And so this is the point that I was making earlier, that the minutes noted that they are wrestling with a two-pronged policy risk. So this is that rock in the hard place. So if they don't keep rates high enough, long enough, you'll have inflation similar to the experience in the 1970s. However, if you keep the higher rates too long, you place large burdens on the most vulnerable groups of the population by way of unemployment. And so once again, I know a lot of people are armchair quarterbacking this whole thing. I just think that, they have an impossible job on their hands, and, it's very difficult for them to sort of navigate this into a soft landing, at least in my opinion. I think from my perspective, I think we do enter into a recession and it could potentially be challenging, but we'll see how this plays out. Now, the article went on to say that the labor market, a critical target of the rate increases, has been resilient, and this is what's been worrying me. And so the number of job openings is still nearly twice the pool of available workers. And so this is my worry, and it makes me believe that we will remain at elevated interest rates for longer, as the Fed is warning that they intend to do so. And the area that they're really watching is that personal personal consumption expenditure price index, less food and energy, it was at 4.7% in November, which is still well above the Fed's 2% target. And, most economists are expecting the U.S. to enter a recession in the coming months. Now, Minneapolis Fed President Neil Kashkari said on Wednesday in a post for the district's website that he sees the funds rate rising to 5.4% and possibly higher inflation if inflation doesn't trend downwards. And so right now, most people are forecasting 5.1% as the top for 2023. So he's actually forecasting 30 basis points higher and even more than that if inflation remains persistent. So again, these guys are warning you, and we really need to sort of take this into account. I don't think that 2023 will be a boom year. I just don't think it's a good idea to fight the Fed. Now, I don't spend a lot of time on macro. I make all of my investment decisions on the micro, and I sort of just gauge whether or not the company will operate sustainably through any environment. However, I do find it interesting to look at the macro and talk to you guys about it. And so I didn't just want to say that the market is predicting a rate increase to 5.1 without showing receipts. So this is the summary of economic projections for the federal fund rates, and you can see that the top for 2023 is 5.1, and then they expect it to taper down in 2024 and 2025. However, if inflation remains persistent and it remains persistent past 2023, you can absolutely see the high interest rates stay higher for longer. So guys, just be careful in this environment. And so I want to hear from you guys. What do you think? The yield curve is inverted, and the Fed has signaled that they're going to further increase again into that inverted yield curve. So what does this overall mean to you guys? Do you think that we're going to enter into a recession, or do you think that we'll enter into sort of like a soft landing type situation? Or are you on team Goldman Sachs that I don't even think they even expect a recession? So let me know what you guys think, and I'll highlight some of the most interesting responses in a subsequent video. And so I'll leave it there for you guys, and I'll see you later.